Today we'll be looking at weighted average cost of capital in financial management. So what is WACC? Capital for investment is provided by investors, and this includes three types of ways in which capital can be raised. The first is debt, the second is preferred stock, and the third is through common equity. Combined, these three are called capital components. And increases in assets is financed by requisite increase in these three capital components. So a company can raise capital entirely through debt or through preferred stock or through common equity, or it could increase finance increases in its assets through each three of them. The formula for WACC is as follows. We multiply WD by RD times 1 minus T plus WP times RP plus WS times RS. So what are these Ws and these Rs? The W is the weight of capital components. That is, what percentage of each component is used to finance the investment in the assets. And R is the cost of each capital component. So WT equals percentage of debt used to finance the increase in assets. WP equals percentage of preferred stock used to finance the increase in assets. And WS equals percentage of common equity used to finance the increase. RD equals return investors require on debt, which equals to YTM, which is yield to maturity on long-term debt. RD times 1 minus T is the return investors get after tax, where T is tax. RP is return investors require on preferred stock. RS is return investors require on. Now let's look at an example for WACC. The data for firm A is as follows. It has 46% debt, 3% preferred stock, 5% common equity. The tax rate is 40%, RD is 7%, RP is 7.5%, and RS is 11.5%. To calculate WACC, we'll first convert the percentage, these percentages, 46%, 3%, and 5%, into weights, by which we will do by dividing 46 by 100 for WD, for WP 3 by 100, and for WS 51 by 100. We'll plug in these weights and the R's that were given in the question, and we'll be able to find our WACC, which turns out to be 8.02%. Let's look at it another example. ABC Motors has a target capital structure of 40% debt, 6% common equity, and no preferred stock. The yield to maturity on a company's outstanding bonds is 9%, and the cost of common equity is 13%. The tax rate is 40%. So we have to calculate the WACC. Once again, we'll convert these percentages, 40% and 60%, into weights by dividing them by 100. So WD turns out to be 0.4, WS turns out to be 0.6, and RD we'll use as percentages. The return on debt is 9%, and the return on common equity is 13%. Next, we'll plug in these values in the WACC formula, and the WACC turns out to be 9.96%.